that kind of thing.
And these are areas of the world that, can't get wireline broadband internet access, so satellite is kind of the next best option?
That's right, and that's a good note of caution on this, that Amazon is competing not just against Starlink, but against every telco around the world that is investing, it's hundreds of billions a year they pump into their networks. So that's one of the things that felled earlier sets of internet from space aspirants, is that, telcos are just good at their job. Sure, there's some pockets where they're not going to connect maybe ever, but, they're always refining their networks.
How much of a competitive advantage does SpaceX have, given that they actually own the rockets that get these Starlink satellites into orbit, whereas Amazon has to rely on someone else, and that's not necessarily Blue Origin?
That's right. Amazon has been really hampered by the fact that there is not a whole lot of non-SpaceX rocket launch available. Amazon has the biggest commercial launch deal in history on its books, but their problem is the biggest providers of launch in the United States and in Europe are between rocket vehicles right now. So they're flying untested stuff. It's going to take a while. Amazon hoped to have some satellites in orbit about a year ago. So they're definitely chasing Starlink, and we saw that they, kind of admitted to that fact recently in signing a deal with SpaceX for a few launches on their Falcon 9 rocket starting in 2025.
Keep your friends closer and your enemies closer, I guess. Hey, let's talk a little bit about Blue Origin, just from the perspective of this being a corollary maybe between SpaceX and Starlink. Could Blue Origin ever serve as a launch vehicle for Project Kuiper?
Oh, they are. They're already on the list. I think Kuiper has something like 12 launches on Blue Origin's New Glenn rocket, which is supposed to be a massive medium or heavy lift vehicle. The problem there is Blue Origin is years behind bringing that to market. We haven't seen the assembled rocket. Blue Origin has never sent anything to orbit before. So Blue was absolutely one of the launch providers that Amazon's hoping to rely on, but they've kind of gotten let down by that other Jeff Bezos company.
Hey, Matt, can you talk a little bit about reporting out this story and the access that you got, speaking to people such as Dave Limp, somebody who's been at Amazon for years at this point and has had his hand in many different parts, including hardware?
Yeah, you mentioned Dave Limp. He started at Amazon working on Kindles. He's an old Apple guy. Then suddenly it was bizarre to find myself talking to him about space topics. He's talking about rocket launches and payload fairings and all this technical stuff. But Amazon's really developed an expertise in that. You can go out and check out their, as I did, I guess you can't, but I did check out their R&D facility in suburban Seattle, and they built, an impressive machining shop, and they've got, antenna testing going on and all this stuff that you just would not think would be anywhere close to Amazon's, core competencies. But if you're willing to spend $10 billion and back a satellite venture, I guess you can find your way there.
Does it seem like Amazon has been able to make the hires? I mean, the type of talent that's out there that is, knowledgeable about this stuff is certainly in high demand right now, and they're competing, not just, down the street with Boeing, but they're also competing, down in Hawthorne with SpaceX, and then of course with Blue Origin as well.
Oh, for sure. In the halls of Kuiper, there's a great mix of, it's kind of aerospace veterans. There's a lot of Boeing people around or Boeing adjacent, but there's also a lot of consumer tech vets. There's some SpaceX people. They seem like they've definitely put a team together that kind of crosses, I don't know, call it the new space playbook, right? You got a little bit of hardcore aerospace, a little bit of commercial consumer electronics work to kind of get the manufacturing chops there. So it's a bit of an eclectic group they've assembled.
Hey, talk to us about Rajiv Bhadyal and who he is.
Yes, Rajiv runs Amazon's Project Kuiper. He's been a tech engineering leader forever. Worked at Hewlett-Packard back in the day doing optical mice, doing inkjet printing. Found his way to Microsoft, where he worked on Microsoft's Zune, the music player. Also had some roles on Xbox. He was tapped by Elon Musk to start Starlink back in 2014. Set up the manufacturing line there, got the first couple satellites in orbit. And then in a flash, Elon flies up to Seattle and the leadership team is gone. And so suddenly Rajiv and a bunch of his pals are looking for work. Amazon had in hand at that point a plan to deliver satellite internet, and there's a management team looking for something to do. So, a few years later, he's got 1,600 people under him at Amazon, and he's having another crack at building a satellite constellation.
Well, Matt, it's just a really fantastic story. We got 10 seconds left. Do you think Project Kuiper can be, just based on your opinion, your reporting, a viable competitor to SpaceX?
If they figure out manufacturing, they can do it, but that's a really big if.
Oh, manufacturing. I mean, Elon Musk is working on manufacturing the Cybertruck right now, and doing anything at scale is in this space is just really, really tough stuff. Hey, again, a fantastic story. I encourage everybody to go check it out. It's among the most read on the Bloomberg terminal today. It's at Bloomberg.com as well. Amazon is spending $10 billion in a challenge to Musk's Starlink. Matt Day, technology reporter for Bloomberg News. Hey, let's get a check on the latest world and national news. We got Scott Carr in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Scott.
Thanks, Tim. CIA Director Bill Burns traveled to Warsaw, Poland today, meeting with the Israeli and Qatari officials. They're trying to restart discussions over hostages held in Hamas in Gaza. Bloomberg U.S. National Security Team lead Nick Wadham says the negotiations will likely be more difficult than the last round was.
These are going to be much thornier discussions because previously it was, basically children, women who were not IDF soldiers, and now really the understanding is that the only people left are essentially IDF soldiers. And so those conversations are going to be a lot more tense.
Bloomberg's Nick Wadham speaking with Joe Matthew and Kaylee Lyons on our Sound program last hour. This could be the first such meeting since talks broke off shortly after Israel ended a days-long ceasefire at the start of this month. Apple will stop selling the latest versions of its smartwatch in the U.S. That's after a patent dispute with Massimo Corp, taking the devices off the market in the middle of the holiday season. Anurag Rana with Bloomberg Intelligence says there's a chance the issue between Apple and Massimo may be resolved.
We were expecting, my colleague Tamlin's done a lot of work on this, that there would be a settlement by now between the two companies. And, we still have a few days. Let's see if this is just armstronging by both the companies, but let's see what happens. But we are hopeful that there'll be a settlement between them.
Sales of the Apple Watch Series 9 and Ultra 2 will no longer be available at the company's online store beginning this Thursday and at physical retail stores beginning Christmas Eve. Hundreds of thousands are still without power in the Northeast due to a major storm, packing strong winds and heavy rains. PowerOutage.us is showing power remains knocked out for more than 600,000 people from Pennsylvania to Maine. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, but not the Russell 2000 pushing higher. Russell 2000 lower, little change right now. But let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. The Dow is little change. Well, the NASDAQ is outperforming here. Dow is currently up 15 points. S&P's gained 25, and NASDAQ is higher by 0.7%. The U.S. 10-year yield at 3.95%. Gold is up 6. Oil trading in the green, but Bitcoin is down by 0.7%. Among the main 11 S&P sectors, leaders were telecom and consumer staples. Only utilities and real estate were in the red. And leaders to the upside in the Dow, Procter & Gamble and Walmart, while UNH and Boeing led to the downside. In deal news, Nippon Steel agrees to buy U.S. Steel for $14.1 billion, and Adobe and Figma mutually agreed to terminate their merger pact. Among the FANG stocks, Netflix hit a 52-week high, and NVIDIA topped $500 per share. In other news, SunPower plunged 32% on an ongoing concern warning. And wrapping things up, HEICO reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg type squawk, SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, well, here we are, less than 18 minutes to go to the close of U.S. trading here on this Monday, December 18th, 2023. I'm Tim Stenbeck. Carol Masser is out this afternoon. It is Bloomberg Business Week. It's time for Drive to the Close. For that, we go to Jay Jacobs, U.S. head of thematics and active equity ETFs over at BlackRock. He joins us on a Zoom from New York City. Jay, good to have you with us this afternoon. Full disclosure to our audience, you and I sat next to each other in a few classes in business school, so that's how we know each other. And you're now at BlackRock, and I'm here at Bloomberg, and we get to talk ETFs a little bit. How are you?
I'm great. How are you doing, Tim?
Yeah, doing pretty well, Hey, did this rally, you just heard the numbers from Charlie Pellet there. Did this rally over the last 8 weeks, did this catch you off guard?
I think it caught a lot of investors off guard because we've seen $6 trillion in money market funds in the United States this year, $8 billion globally. So a lot of people were looking at cash yields and thinking, I don't know what's happening in the markets. I don't like the risk out there of a recession or general volatility. I'm going to take 4 or 5% yield in cash and call it a day. And instead, we've seen the S&P is now up almost 25% on the year. That's the risk of holding cash. We know over the long run, participating in markets is key to investor success. Trying to time it can be very difficult, though. So I think this caught a lot of people off guard.
Yeah, trying to time it is a fool's errand. I mean, ask anyone who missed this rally here, Jay. That's the thing, though. There is still, trillions of dollars on the sidelines right now in these money market funds, in these cash funds. How do you see that getting deployed in 2024?
I think the bar is high to bring that cash off the sidelines.
Really?
Investors have voted with their dollars this year. They've said they like the yield. If you're going to take money out of cash, out of a yield, a yielding bank account and put it into the markets, you need to have a really compelling reason why. And so we are looking at really what are the specific areas that are exciting. I think the challenge, Tim, is if you look back over the last 10 years or so, we call it the Great Moderation. Interest rates were falling, growth was strong. It was really a great time to be in just a 60-40 portfolio. It almost didn't matter what you bought. Almost all assets were rising. But now in this higher volatility, high interest rate environment, you really have to get more precise about honing in on where the growth areas are in the market. And I think that's where investors are going to have to do their homework of looking at, I want to come out of cash, but what are the attractive areas? It's not just about broad benchmarks anymore.
Okay, so let's talk about the thematic outlook that you guys have over at iShares by BlackRock. You talk about this higher bar. I know you're also really interested in AI. And if we characterize 2023 and, really, if there's one way to describe 2023. It's certainly the year when investors started paying very close attention to AI, and we saw some big winners: NVIDIA, Microsoft, and even some startups like OpenAI as well. How are you guys thinking about AI in 2024?
We see AI in 2023 as really just the proof of concept year. ChatGPT burst onto the scene. A bunch of people played around with the technology, but not a lot of commercial adoption. You haven't seen billions of dollars in revenue coming to a lot of these AI companies yet. So 2024 is going to be that year of commercial success where this technology is proven, and you're going to start to see more enterprise applications for AI as well as more consumer applications. I think just an example, we've seen some companies already say they expect to save hundreds of millions of dollars in client service because now they can use AI to respond to basic questions. How do I reset my password? Where do I find my account information? And they can, really use AI for kind of that low-hanging fruit questions from clients, whereas using their more sophisticated human answers for the more sophisticated questions. So, in fact, about 60% of CEOs who intend to use more AI next year have said they want to do so for cost-saving measures. So if we're in a tight economy and AI is looking really promising as a technology, I think we're going to see much more investment in it for companies to bring down their cost base.
So what are the types of companies that end up being the beneficiaries there? Let's say that, people are saying to themselves, well, wait a second, we know that NVIDIA has done really well this year, but now we enter the part of the AI revolution where we start to see companies, as you mentioned, embrace this technology and lead to real cost savings. Which are the types of companies that are going to do that?
Yeah, we really have to look across the AI tech stack to find those companies. So at the basic level, you look at the hardware. Those are the semiconductors that are really powering these AI systems. It includes some of the really powerful GPU manufacturers, but also includes several of the CPU manufacturers that can be really efficient for AI processing. One level above that, you can look at digital infrastructure. Where is all these semiconductors being housed? AI doesn't just happen in the air, in the cloud. It has a physical location where these calculations are happening. It's the data owners. Data is the fuel into AI. So the companies that own the most data, have the most valuable data, are sitting, potentially on really valuable information there. And then finally, at the highest order, these are the companies that are building applications using AI. So if we take a step back and look at, the last decade or so, a platform technology that built many businesses was 4G technology. It allowed us to get data faster on our cell phones anywhere where we were in the world. That allowed for things like mobile e-commerce, mobile social media, so that we could stream videos and shop wherever we are. The new platform technology for the next 10 years is going to be AI. What is the next e-commerce? What is the next social media that's going to be built on top of that technology?
Hey, what about when it comes to just geopolitical events and demographic changes that you see happening and that you guys are planning for in terms of your the products that you offer at iShares by BlackRock? Let's talk presidential election in the next year. I mean, how should investors be thinking about that?
Well, I actually think this goes beyond the presidential election. If you look at really from the end of World War II through the global financial crisis, you saw globalization really in one direction, more and more globally integrated trade. But over the last few years, you've started to see new industrial policy in the United States with things like the Infrastructure Investments and Jobs Act, the CHIPS and Science Act, the Inflation Reduction Act, all ways to build more critical industries in the United States, like semiconductors and electric vehicles. And that means that we need a lot more manufacturing, but we also need a lot more partner countries that can help us build all those things. Earlier this year, Mexico became the biggest trade partner of the United States. Huge landscape shift there. We've seen more trade with India and, frankly, reduced tariffs with India as we're looking to diversify supply chains into other countries around South and Southeast Asia. So as we try to build more and really secure key industries in the United States, it also comes down to who are the partner countries that the United States wants to work with for these new supply chains.
Jay, we only have like 20 seconds left, but given that we're up almost 25% on the S&P 500, are you bullish overall next year?
I am. I think I'm very optimistic that a lot of the cash on the sidelines is going to find these attractive areas like AI, like geopolitical fragmentation, and our aging populations.
All right, Jay, really appreciate you joining us. Happy holidays if we don't connect before now and the next couple of weeks. Jay Jacobs is U.S. head of thematics and active equity ETFs over at BlackRock. He joins us on Zoom from New York City. Let's get a quick update on the numbers. The Dow's pretty much flat right now. The S&P 500 is up just about half a percentage point. The NASDAQ composite up close to 0.8%. This is Bloomberg Business Week.
Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Apple will stop selling its Watch Series 9 and Ultra 2 in the U.S. just before Christmas as a result of a patent dispute over the blood oxygen sensor. Apple says sales will stop for the two flagship Apple Watch models online on December 21st and in physical stores as of December 24th. Dan Ives is with Wedbush Securities, and on surveillance this morning, he told us he's not too concerned.
I mean, look, there have been some issues on the Apple Watch side, and a lot of it is really around models in terms of what they're trying to drive. I view this as just a small bump in the road, but I actually think watch sales this holiday season are going to be up double digits. So I view this as sort of noise relative to the broader story.
In the meantime, more Chinese agencies and government-backed firms across the country have ordered staff to stop bringing iPhones and other foreign devices to work. More from Bloomberg's Alex Webb.
What we heard a few months ago is that, particularly in Beijing and Tianjin, that there was a pushback from some government agencies and state-owned companies, not least PetroChina, huge employer in that part of the world, forbidding them essentially from using Apple devices in the workplace. What we've now seen, according to Bloomberg reporting, is this is extended to 8 further regions.
And that's Bloomberg's Alex Webb reporting. Apple shares are trading lower. Right now, we do have Apple down by 0.7%. And those are some of the top company stories that we're following for you at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. We're less than 5 minutes to go to the close of U.S. trading on this Monday afternoon. I'm Tim Stenivek. Carol Messer is off this afternoon. It is Bloomberg Business Week. I do want to welcome in Charlie Pellet. You just heard from him when he gave a rundown of the top stories and business news that he's paying attention to. Charlie, have you taken a look at shares of Apple and what they're doing today?
Indeed, Apple shares are declining today. We do have Apple down now by about 0.8%, 196 on Apple. We did hear from Dan Ives, and by the way, his price target on Apple, if I recall, is $250.
Okay, so it's at 196 right now, so 250, quite the upside for Apple. Shares fell as much as 1.6%, a little bit early in the day. This is a big deal, but it isn't hitting the stock as hard as it was earlier in the day, Charlie. Apple, you mentioned this, is going to stop selling the latest versions of its smartwatch in the U.S. due to this patent dispute, taking some of its best-selling devices off the market during the busy holiday season. We're talking about the Apple Watch Series 9 and the Ultra 2. Sales of those smartwatches will be halted on the company's online store starting December 21st. That's Thursday. And then its physical retail locations beginning on Christmas Eve, the company said in a statement today. So if you are looking to get those watches for the holiday season, Charlie, you better get them soon.
Indeed, and it follows a patent dispute with Masimo around its blood oxygen sensor technology. Masimo shares up today by as much as 5.5%. Our Anurag Rana, and Bloomberg intelligence analyst, says the sales halt just adds to the company's challenges in China with its iPhone business. Certainly done a lot of reporting on what's happening there, but just one more complication for Apple. But again, Tim, shares not doing a whole lot of anything. Yes, the market is up today, but we've got Apple shares, as I mentioned, trading lower. Little change right now, down by about 0.7%.
Yeah, we'll have to wait to see to what extent this affects the company's sales. It is getting to the end of the quarter, and the vast majority of holiday shopping will be done by the time these are taken off the shelves. The Series 9 and Ultra 2 models generate the vast majority of Apple's watch sales. The company doesn't actually say how much revenue the product line brings in, but it is a core part of its wearables, home, and accessories business, which generates more than $40 billion a year. According to some analyst estimates, the Apple Watch alone made about $17 billion in fiscal 2023, which ended in September. So we're in the first fiscal quarter of 2024 right now for Apple. Hey, don't go anywhere, because coming up, we're joined by our Bloomberg TV team for our cross-platform coverage. Bloomberg's Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu counting you down to the closing bell, and here to help us take us beyond the bell with a global simulcast. We're joined now by just Tim Stenovic, Carl Master, out this week. Tim, how you doing in there?
I'm doing well. You know, I've had some good visitors in here over the last hour. John Authors from Bloomberg Opinion came by and we had a good chat. Charlie Pellet is in here regularly too. So I got a great crew. I don't want you guys to worry about me at all. Although I will tell you, a lot of our guests have been joining us remotely. I think there's something going around right now. People who were supposed to come into the office and actually be with us on set today, calling in sick, but they're still joining us remotely.
The weather.
Yeah. That too. I mean, more than 2 inches of rain over the last 24 hours here in the New York City area. Hey, we did just have a great conversation with Jay Jacobs.
You said we, Tim.
We, the royal we.
Maybe he and Charlie Pellet did.
Me and myself had a great conversation with Jay Jacobs. I don't want to say I had a great conversation, but I guess I can say I did.
Own it.
With Jay Jacobs. He says that he's over at BlackRock. You guys know him well.
We
he
do.
Handles iShares and just heads up thematic ETFs.
Yeah,
he's bullish. I don't know if you knew that.
Yeah.
Even though the S&P 500 is up more than 23% so far this year, he thinks that the cash on the sidelines in those money market funds, the $5 trillion, is going to come back in to the market. But he argues for like a disciplined approach here. You know, there's a high bar, he argues, that people are going to need in order to actually make those investments over the next year.
I know we keep talking about this almost $6 trillion that's sitting on the sidelines, but are people definitely are they necessarily going to put some of that money to use right now when all these equity indexes are at or near record highs?
Also, does it belong to the equity market? What about corporate credit? What about treasuries? In any case, you take a look at how we're closing up today as the bells ring. You take a look at the S&P 500 up 0.5%, not quite at a record high. We are a breath or so away, that record high from January 2022, just under 4,800. We'll see if we get that by year end. You take a look at the NASDAQ composite up about 0.6%, and the Dow Jones, of course, this hit a record high last week, but that index, Tim, just about unchanged on the day.
All right, well, peeling back the layers of the S&P 500, you had 293 stocks move higher in the S&P 500, 209 moved lower, 19 stocks on the Dow moved higher. Well, we saw 11, Scarlett, move lower on the day.
Yeah, so definitely an upward bias here in equities. Let's take a look at the sector performances right now. Media and entertainment, that's your Netflix, that's your Meta, boosting that group up by more than 2%. Food and staples, these are retails, names, and they're up by 1.7%. I just checked Costco, continuing to build on recent gains following the special cash dividend that it announced. Retail overall gaining by 1.6%. On the downside, you have tech, hardware, and equipment losing 2/3 of 1%, autos and components down about 1/2 of 1%, and banks losing 0.4 of 1%.
All right, well, because I'm solo in the radio studio this afternoon, I got the gainers and the decliners.
Wow.
I want to start, no shortage of companies to pick from. We got some interesting and notable moves all around them. I want to start with U.S. Steel. Shares finishing the day higher by more than 26%, Katie. Soaring to the highest intraday level, at least since 2011. Some M&A news here moving the stock higher. Nippon Steel agreeing to buy U.S. Steel for $55 a share in cash and an equity value of $14.1 billion, plus the assumption of debt for a total enterprise value of $14.9 billion. We should note that Senator John Fetterman, Democrat of Pennsylvania, he actually vowed to block the deal. He called it, quote, outrageous, and said it's another example of hardworking Americans being blindsided by greedy corporations willing to sell out their communities to serve their shareholders. He said this in a post earlier today, though, so not seeming to move the stock, the regulatory concerns there at least. And then shares of Adobe also finishing the day higher. More M&A news, but this about a deal not actually happening. Shares of Adobe finishing higher by about 2.5%. The company agreeing to walk away from its proposed acquisition of the startup Figma, this coming from regulatory opposition, particularly in the European Union and the UK. It was a $20 billion deal. Adobe is going to pay Figma a $1 billion termination fee. Analysts, though, saw the termination as a positive for Adobe, and Barclays actually upgraded the stock in the wake of that. And then let's get over to decliners and talk about Apple. This is a story that I've been obsessed with. I talked about it with you guys last hour, spent some time talking to Charlie Pellet about it. Just checking in on shares at the end of the day, down about 0.8%. This after the company said it's going to be pulling those latest versions of its smartwatch from shelves ahead of the holiday season as a result of this ongoing patent dispute. Shares fell actually as much as 1.6% earlier in the session. And then SunPower Corp finishing the day down by double digits today. It plunged the most ever December intraday, down more than 31%, breached a credit agreement and said there's, quote, substantial doubt about its ability to continue operating. If SunPower's lenders demand immediate repayment, the company wouldn't have enough liquidity to meet its obligations and pay its liabilities. The company said, quote, as such, substantial doubt exists about the company's ability to continue as a going concern.
You know, you mentioned earlier, Katie, why not corporate credit? That's why.
Yeah. Why not?
Because of possibilities like that. And people don't
Scarlett.
know how to pick winners and losers. They're not doing the homework on every corporate bond.
It's a good point, and definitely something to keep in mind, because the point that we've been talking about is that even though interest rates theoretically coming down next year, they're still super high. And on that note, let's take a look at how the bond market is faring today. You did see a little bit of a sell-off. Of course, the narrative has been this big bond rally that we've seen, especially in the wake of Jerome Powell last week. But a little bit of pushback coming from some of the Fed speakers in the wake of Jerome Powell. That's not really making a dent in the stock market, as we've been discussing, maybe more so in the bond market right now, but we're talking about pretty small moves overall. The 2-year yield up just about a basis point. You go out to the 10-year up about 3 basis points, so nothing major here. But I did want to bring us some of this Fed speak. Of course, John Williams kicked us off on Friday saying that they're not really discussing the timing of rate cuts. That, of course, was one of the big headlines coming out of that press conference on Wednesday. And then Loretta Mester coming just today saying that the financial markets are a little bit ahead when it comes to rate cuts. You think about the Fed's dot plot at 75 basis points of cuts next year, the market at 150 basis points. Maybe that's more than a little bit of a goal.
You know, I was looking at the EcoGo function on the Bloomberg, and you pick central banks on the drop-down menu to see which Fed speakers are coming up to speak. And last week there were only 2. You had Goolsbee, and then you had Bostic speaking again. But they've added a couple more names. Tom Barkin will be speaking tomorrow, and actually Austin Goolsbee will be speaking a couple of times in the next few days. So more opportunity to push back, walk back, talk back to what Jay Powell had indicated on Wednesday.
Yeah, but it seems like markets have decided what they want to do. And Katie, I think you make a good point that the equity market has absolutely ignored any of this so-called pushback. So I'm
because
kind
they're
of
looking for the Santa Claus rowdy.
Exactly, and they're hearing what they want to hear right now. And I think it's really notable that we've had such a. It hasn't been super forceful, but it's been notable that Fed speakers have come out and said this. Though Mike McKee making the point over the weekend in a long post on X that I Twitter, whatever it's called, that I retweeted. You guys should check it out. That talks a little bit about, kind of goes into how Jay Powell answered some questions and said, what these Fed speakers are saying in the wake of this is not that different than the way that he answered some of the questions during the press conference.
But people hear what they want to hear.
Exactly. That's the important point.
And I did see that post. I thought it was really important context. And to the point on the timing of rate cuts, definitely. But it was also the fact that Jerome Powell had multiple opportunities to push back against the easing in financial conditions. It didn't come. And I mean, at this juncture, you think about how far markets have moved. To not push back really seems like endorsement.
Financial conditions, I'm always thinking about this. Are they a reflection of policy, or do they drive policy? It feels like they do both, in which case it's just the circle that goes round and round.
So what are the catalysts that we have between now and the end of the year? We have these Fed speakers who are being completely ignored when they come out and do make comments. But what about corporate earnings and, hearing from FedEx tomorrow or Nike later this week? Does it give us an idea of the consumer? Does it give us an idea of the economy? FedEx certainly will do that. But is it actually anything that moves the needle, Katie?
I mean, you think about, too, some of the real-time data that we're going to get on the strength of the consumer over the holiday period. Of course, all of the travel data as well. But in terms of anything that's really going to alter the course of this rally, of this market, I don't know, you guys.
I mean, there is PCE coming up later this week, and that will certainly be important because that is the measure that the Fed really watches. It's its favorite inflation indicator, but there's a long time between that PCE and, of course, when the Fed speakers really come out in force once again, and when most of the market is back participating again, too. So it could be easy come, easy go.
Wouldn't it be nice, though, if we could all just chill out, just like ride
Maybe Fed speakers should come out and say that.
Yeah, like, guys, just calm down. We'll talk about this in January. Don't worry about it.
Not going to happen.
I don't know.
Not going to happen between now and then. Maybe. I don't know. I think next week is going to be pretty chill.
Well,
I think so.
Tim, we have to leave you now.
I know. Are you worried? Are you worried about me?
You singular.
I'll be okay.
I'm worried about you.
I will be okay. Do not worry about me. Hey, that is going to do it for our Beyond the Bell coverage. Hey, thanks for letting me hang out with you guys on this day when I'm all alone in the studio. Our cross-platform coverage of the market close on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Meantime, catch us tomorrow, same time, same place. Ending the year on a high note after months of disappointing volumes. We spoke about a bunch of these with our TV team just now. Nippon Steel leading the way with $14 billion takeover of U.S. Steel. Clear Lake Capital and Insight Partners confirming a Bloomberg News report that they've been taking data analytics from Alteryx private in a $4.4 billion deal. We saw some more private equity with Koch Industries taking a $3.6 billion acquisition of an Iowa fertilizer business from a Dutch chemical firm. That became official. IBM bought $2.3 billion of data integration platforms from Germany's Software AG. Today was a really busy day, but something has fundamentally changed when it comes to these deals versus the deals that we've seen over the last decade or so, and that's none other than interest rates. Companies that relied on cheap credit to fund big mergers and acquisitions during the boom times now face a challenge, and that challenge is how to keep lofty M&A promises while servicing large debt loads in a new environment of higher rates and fading consumer demand. That challenge is the subject of today's Big Take, written by a trio of reporters, including our next guest, Nina Tretman. Nina is a senior editor at Bloomberg News, and she joins us here in the Bloomberg Interactive Brokers studio. Nina, good to have you with us this afternoon. Congratulations to you and the team on today's Big Take.
Thanks for having me.
Yeah, take us through the analysis that you did here, because you guys really dug through the data, you dug through the numbers to find how these M&A deals are faring in a higher rate environment.
Yeah. We went through company filings, bond indexes, and also rating firms reports for about 75 of the largest corporate acquisitions over the past 5 years. Of course, all done and struck during a time of low interest rates when companies were able to borrow relatively cheaply, and we're also making, as you said, lofty promises about synergies, debt reduction, and also the enhanced revenues that they would generate from these deals. As we found, looking at the deals, we found that the results are not as great as companies were hoping for, including that companies still hold a lot of debt. So less than half of companies have managed to cut leverage since the acquisitions. Almost a third of the companies have leverage ratios above 3.5 times, which is in many industries reasonably high. And then we also have average net debt to EBITDA levels of 2.7 times compared to 2.4 times, also indicating that leverage ratios are still high. And of course, now as companies are entering this period or have worked in this period of slower economic growth, financing costs rising, we're seeing that many of the deals are struggling. We mentioned a few in the story.
Yeah, I want to get to those in a minute.
Right.
First, though, I want to talk a little bit about the way the environment has changed just in the last month, or even in the last week, with Fed Chair Jay Powell coming out and, well, what he said and what markets interpreted perhaps are two different things, but the way that markets read into what he said in his press conference and what the dot plot showed us was that they're optimistic about rate cuts next year. Is that affecting the corporate borrowing rates of these companies that you talk about? I mean, shouldn't their rates be moving lower than they were at least, in the last few months?
Well, many of the companies that we looked at for the story do have, because many of them are investment grade rated or were investment grade rated at the time when they did their deals, many of them did have fixed rate debt. So the fact that financing costs have changed doesn't necessarily impact the current financings that they have outstanding. That said, many of the companies, of course, that we saw in 2020 and in 21 tapping cheap financing will have to come to the market next year or the year after that. So if interest rates and financing costs were to move lower from here, then yes, they would see a benefit. Those that have floating rate debt will see an immediate advantage, but that's not necessarily always the case, given that investment grade companies usually like to lock in fixed rate debt.
So what are the implications of these companies coming out that have, leverage ratios of above 3.5% compared with 16 at the time of acquisitions, or net debt to earnings before interest, taxes, depreciation, and amortization at 2.7% compared with 2.4 previously? Where do we start to see the implications of that?
So important thing is, of course, so this is leverage ratios of 3.5 times and also 2.7 times.
Yeah.
So this is basically looking at the amount of leverage that they have versus the earnings that they generate. Interesting thing is what we also found in the story is that ratings firms so far have been pretty accommodating to these companies. So we've actually only seen a few cases where companies were downgraded. We've recently seen Walgreens, for example, that was cut to junk. But overall, and that's also one of the things that we found in the story, is this, that the companies could have seen ratings downgrades, but necessarily haven't yet. So it is one thing to see for next year and how far economic indicators change and in how far the performance of these companies either improves or declines, for ratings firms then to also potentially consider ratings cuts. For many of the companies that we looked at, actually ratings were not changed or very modestly changed.
And that would be a big deal if there was some sort of mass re-rating of these companies that are out there, especially if we see a decline in earnings.
Yeah, ratings for next year are expected to decline from current levels across the board, not just for companies that have seen, that have done deals. And of course, it will depend on the industry, it will depend on the individual company and what they've done, but there will probably be more focus from ratings firms to see if companies are performing the way that they would like them to.
Okay, so now let's get to some of the companies that you and the team did analysis on. What stuck out to you?
I think one thing was certainly this, that the combination of factors, including interest rates, economy, all those things sort of did have a dent for some of those companies that did deals, but then also there were deals where you just saw that there was strategic questions as to whether this is a deal that will work and is this a deal that will generate the returns for shareholders that the companies were hoping. So one of them was Walgreens that acquired Summit Health, a sort of healthcare services provider.
Yeah, New Yorkers will be very familiar with this one.
Because of the CityMD
on every
brand.
corner.
Yeah, right.
Or at one point they were. I don't know if they still are.
Right, and so that's, I guess, one where there's not just the question around high leverage, but also the question as to, is this strategically a good move or not? Walgreens, of course, is now considering to potentially sell their UK arm Boots to bring down debt potentially with the returns. One of the deals we also looked at was Bayer Monsanto, where the company was A- rated at the time when they struck their deal, now is BBB rated and has shelved a fair amount of its market cap and also its financial reserves because it keeps losing these Monsanto cases. So I guess those are all questions where sort of it's the financing environment is one thing, but then also the question, is this strategically a good deal or not, of course, comes much more to the forefront in these kind of times.
Right, which are two completely different questions at this point, but one of them hits harder at a time when there are questions about not just the U.S. economy, but the global economy as well. I was going to ask about, just in the last minute or so that we have, not every acquisition is a home run, regardless of the environment. In fact, oftentimes you look at acquisitions later in a publicly traded company, and it turns out that wasn't a good acquisition, regardless of the funding environment. How did you reconcile that with this analysis and the differences when, okay, well, it's not, these aren't always a home run.
Right. Of course, for that, the 5-year horizon that we took for the story is probably a little too short, given that for many deals, that companies aim to be accretive in the first few years after closing, but then sort of to see whether strategically a deal made sense or not, you probably want to look a little further than those 5 years. What I've been hearing from CFOs recently is certainly this, that in this more uncertain time and also in this time when financing costs are higher, given that the Fed hasn't really lowered rates yet, that they're saying, hey, the hurdle rates are higher.
I see.
So the thresholds that new deals will have to overcome will be higher, given that investors at a time of like also next year, the election, for example, will be more cautious.
Nina, it's a fantastic story. Nina Trendman is a senior editor at Bloomberg News. Check out her story on the Bloomberg Terminal, The Big Take on Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. We do check markets all day long here at Bloomberg. The relentless rally for the U.S. stock market continued again today. After 7 weeks of gains, S&P up another 21 points today, up by about 0.45%. The Dow up 1 point today, little change there. NASDAQ up another 90, higher by 0.6%, bringing its year-to-date gain to 42.4%. 10-year yield 3.94% with a 2-year 4.45%. Spot gold now at 2,026, up today by 0.4%. West Texas Intermediate crude oil up 1.7%, 72.66 for a barrel of WTI. Nippon Steel is buying United States Steel for $14.1 billion to create the world's second largest steel company and the biggest outside China, with a key role in supplying American manufacturers and automakers. This deal caps months of uncertainty over the future of U.S. Steel, an icon of American industry, which had been considering potential transactions since it rejected an offer from rival Cleveland-Cliffs for $7.25 billion in mid-August. Today, U.S. Steel surged 26%. ADRs of Nippon Steel down 4%. Cleveland-Cliffs today up by 9%. Again, recapping, U.S. stock market advanced today. S&P up another 21, up by 0.45%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. Check out the new Bloomberg Business app. It features Apple CarPlay and Android Auto. You can listen to Bloomberg Business Week and all of our Bloomberg radio programs anytime. All you got to do is download the Bloomberg Business app on your smartphone and then connect your phone to your car. It's free in the Apple App Store or on Google Play, thanks to our sponsor, Interactive Brokers. Well, some public companies are still trying to figure out exactly how to comply with new rules from the U.S. Securities and Exchange Commission requiring speedy disclosure of significant cyber attacks. Those rules, which kicked in Monday, require companies to report cyber incidents within 4 business days of determining that they are, quote, material to shareholders. The SEC previously required firms to disclose major events that would be of shareholder interest but didn't specify cyber events. We did speak earlier on our program about cyber attack hurting orders for Vans, North Face, Dickies, Supreme, JanSport, Timberland owner VF Corp, and the way that those can really bring a company offline, especially at a crucial time like during the holiday season. Well, our next guest knows a thing or two about cybersecurity. Wendy Thomas is president and CEO of SecureWorks, the cybersecurity company. She's back with us once again, joining us on Zoom from Atlanta, Georgia. Wendy, good to have you with us this afternoon. How are you?
Well, I'm doing well. Thanks for having me, Tim.
Well, thanks for joining us once again on this. It's a little different environment than when we last spoke to you just a few months ago, specifically when it comes to this new SEC ruling that requires speedy disclosure of significant cyber attacks. It seems like there's a lot of confusion with what exactly companies now have to disclose to their shareholders when it comes to cyber attacks. What can you tell us about it?
Sure. Glad to share the emerging insights into the new regulations. I think about it in sort of the front end and the back end. On the back end, as you mentioned, public companies now have to report cyber incidents that are determined by the company themselves to be material, which is a discussion in and of itself, within 4 business days. And so that's the primary back end requirement. But on the front end, the disclosures around everything from policies governing cybersecurity risks, the company's risk management processes, processes whereby management is informed about cyber incidents, and the board's oversight of that. All of those are now required to be disclosed in annual 10-K filings by public companies. And so the scrutiny of whether we are preparing sufficiently for cyber incidents, as well as disclosure about them on the back end, is significantly ramped up.
I want to talk about this just because this one's in the news, but you could just replace VF Corp with, any given company at any given time. VF Corp suffered this cyber attack at pretty much the worst possible time in the most important quarter of the company. And it has hurt orders for Vans, North Face, and other brands that the company has. I'm wondering, how this stuff continues to happen when we understand that the threats are out there and so many companies are spending so much money on keeping their network safe.
They are spending significant amounts of money, but as you can see, the cyber criminal only has to be right once. And we have to be right in and out every day. And that's why it's so important for companies to have a security expert partner to help them prepare for and navigate situations like this to minimize the damage. There's nothing worse for a company than their high season to be impacted by this type of a cyber attack. And to be frank, the reason these regulations are in place is that when things like this hit the headlines, regulators feel impelled to incent companies to protect themselves proactively, and then to be straightforward with shareholders or investors around what may be impacting their business in terms of its operations or financial performance. And this is a case in point of why we see new regulations coming out around this.
In your opinion, do the regulations go far enough?
The regulations, I think, are a good first step in many ways, and I have no doubt we'll continue to see them evolve like many other new forms of rulemaking over the years. But what I will tell you is these regulations are not intended to punish. They are really intended to create the right incentives. Look, 2023, I think it's on track to be the most prolific year for ransomware ever, and to have one of the highest economic costs of security breaches to date. Right, this cybercrime is an ongoing, continual transfer of wealth to criminal enterprises. And so I think that the SEC feels compelled to provide guidance around how to better prepare for these types of situations going forward. And frankly, I've raised the bar for CEOs, CISOs, and boards of directors around preparing for these types of incidents.
What, in your opinion, is the right amount of money for a company to actually spend on keeping their company secure from cyber attacks? Not a single figure, but a certain, like a portion of revenues, for example, or a portion of expenses.
That does vary a bit, and I'm glad to provide some ranges there. It does vary a bit depending on whether the organization is in a highly attacked and frankly highly regulated industry.
Meaning like a healthcare or a financial services, for example?
Exactly. They have a much higher standard. Now, what we see is damages to companies that are more in the manufacturing and the retail space. So it does matter from a business uptime and financial performance perspective. But generally, we expect to see companies spending somewhere in the 4 to 5% range. It can sort of merge into other technology spend a little bit because you can have secure by design technology deployments. But somewhere between that and 12 to 15% of your total technology spend is what we see typically in place, again, for businesses that aren't necessarily in a highly regulated industry.
Do you see that portion moving up?
I do see that portion moving up, but I also see it moving in terms of mix. So while you want to invest in preventing as much as you possibly can, what these regulations are showing is that you have to invest in you weren't able to prevent everything. So you absolutely have to be able to detect quickly, because with these regulations, the ability to assess the impact of an incident in terms of what it's going to do to your business operations and the financial outcomes of that, you absolutely cannot do that with humans alone. It requires technology investments and investments in awareness and preparation of your team. So I do think that the mix is going to shift quite a bit towards the detection and preparation aspect of this.
Wendy, we've talked a lot about AI in the context of making companies more productive and being able to be more efficient. We've talked about it too in the concept of people being worried about AI, sort of like the way that Elon Musk is concerned about AGI. I'm wondering how you've seen or how you could see threat actors use AI to pose as humans, to actually gain access to networks. What's worst case scenario here that you guys are thinking about over at SecureWorks?
Sure. As we've talked about before, the power and the peril of AI is very real for cybersecurity. And so while the power of it to be able to detect certain behavioral techniques of the adversary are incredibly important for how we operate as SecureWorks. We also see the adversary taking advantage of these tools and techniques as well. And I think the most near-term one that we have seen and increasingly concerns us in terms of its accelerated use is around deep fakes, with the ability to impersonate a CEO, not just in an email, but in a video, and to do that at scale with large language models like ChatGPT. It just has put a pace of deployment and a fidelity of believability in what they're using to deceive. It's just taken it to another level. And that's the primary area where we're focused on. The ability to detect.
Yeah, one hard thing is, you have to remain so vigilant, regardless of who's, in your organization, from person with access to certain systems versus just a person whose password or login credentials could be compromised. Wendy, we love it when you join us. Wendy Thomas is President and Chief Executive Officer of SecureWorks, back with us on Zoom from Atlanta, Georgia. You're listening to Bloomberg Business Week. Let's get a check on the latest world and national news. We got Scott Carr in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Scott.
Thank you, and good afternoon. Israel's facing growing pressure at home and internationally over its campaign in Gaza against Hamas. This after Israeli defenses accidentally killed 3 hostages in Gaza and 2 women who were taking refuge in a church, sparking outrage. Today, CIA Director William Burns is meeting with Qatari and Israeli officials in Poland to talk about the hostage situation and a possible humanitarian pause. The Biden administration will roll out one more package of military aid for Ukraine before the end of the year. That from National Security Council spokesman John Kirby today. As Bloomberg's Amy Morris tells us, the Defense Department's running out of money to replace the equipment sent to Ukraine.
Comptroller Michael McCord, in a letter obtained exclusively by Bloomberg News, told lawmakers the Pentagon plans to repurpose more than $1 billion to help replace defense equipment and defense services provided to Ukraine. The Pentagon is pressing Congress to approve a $61 billion security supplemental for Ukraine, but that package is in limbo. Meanwhile, McCord says the transfer of funds marks the end of, quote, the funding available to us. He says the Pentagon may provide Ukraine with only one more presidential drawdown package. In Washington, Amy Morris, Bloomberg Radio.
A storm moving up the East Coast has knocked out power to thousands, grounded hundreds of flights, and as Bloomberg meteorologist Rob Carolyn tells us, will continue to cause dangerous winds through this evening. New York City seeing some of the worst of it with heavy rain and wind gusts up to 60 miles an hour. The late Justice Sandra Day O'Connor is being honored at the Supreme Court today. Justice Sonia Sotomayor said O'Connor was devoted to making the world better over the course of her career. The late Justice will lie in repose inside the building's Great Hall so the public can pay their respects ahead of a funeral service tomorrow. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Another move higher for the U.S. equity market. The Dow at a record, little changed, higher now by 1 point. S&P today up 21 at 4740 for the S&P. That was a gain of about 0.45%. The Nasdaq Composite Index up 91, up 0.6%. The Nasdaq 100 Index up 106, higher by 0.6%. A retreat, though, for the Russell 2000, down 2 points, down by about 0.1%. 10-year yield 3.93% with a 2-year 4.48%. The relentless rally in stocks extended today, lifted by a number of deals as traders largely ignored tempered messaging from Federal Reserve officials. As for the market backdrop, Jade Jacobs is U.S. head of thematics and active equity ETFs at BlackRock, and he was a guest right here on Bloomberg Business Week.
A lot of people were looking at cash yields and thinking, I don't know what's happening in the markets. I don't like the risk out there of a recession or general volatility. I'm going to take 4 or 5% yield in cash and call it a day. And instead, we've seen the S&P is now up almost 25% on the year. That's the risk of holding cash.
And you can hear more of that conversation on the Bloomberg Business Week podcast. Point Biopharma global shares plunged today after its prostate cancer drug, a potential competitor to Novartis's Pluvicto, had mixed data in early results from a late-stage trial. Today, Point Biopharma Global was down by 11.2%. Spot gold up 0.4%, 2,027 on gold today, while West Texas Intermediate crude rallied 2%. Brent actually up 2% to 78.04 barrel of West Texas Intermediate up 1.5%, 72.50 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate it. Well, our next guest has made his living connecting people. Sam Darwish is the co-founder, chairman, and CEO of one of the world's largest independent owners, operators, and developers of towers, providing communication infrastructure in 11 markets, serving about 770 million people. He joins us on Zoom this afternoon. He's the CEO of IHS Towers. It's got nearly 40,000 towers across Africa, Latin America, and the Middle East. Also the co-founder and chairman of the company. Good to have you with us this afternoon, Sam. How are you?
Good. Thank you. How are you?
Hey, I'm doing really well. Hey, this is perfect timing for you to come on our program because our own Bloomberg technology team, Matt Day and team wrote a piece about Project Kuiper earlier today about Amazon's foray into providing high-speed internet. And he said, Amazon's not just competing against the SpaceX's Starlinks of the world. He's competing with anyone out there right now providing connectivity. And that's a company like yours that provides the infrastructure for connectivity. How are you seeing the landscape right now in the markets that you operate?
Look, we operate, as you said, we own 40,000 towers roughly across and fiber in the tens of thousands of kilometers, covering 8 or 9 million homes across our markets. Our markets we operate in 11 countries across the world, covering roughly 800 million people, as you said. So we kind of see the trends, understand what's happening. The likes of Amazon, the likes of Google, the likes of Facebook, do from time to time come to our markets, trying to stimulate basically demand for their own services. But we haven't seen them come into our markets with big statements or with big projects that could move the needle. Now, having said that, at the end of the day, I get Starlink, I get all the projects or the ideas of trying to create connectivity using satellites or non-terrestrial systems. But when it comes to basic propagation, basic wireless, there is no alternative to a tower on ground.
Really? Why is that? Because, here I am thinking to myself, this could be a prime moment for, what you guys in the industry call leapfrogging here. The technology, this infrastructure technology is so expensive. I don't have to tell you. You guys own and operate 40,000 of these towers. These are very expensive things to build and to operate. And then you have this other technology coming in that essentially broadcasts internet from the sky. Why is this not a serious concern to you at this point?
Because the technology has limitations. I'll list a few. The first is that as you're trying to penetrate a building or a structure sideways from a tower, it's much easier because you're kind of like going through windows and glass and this and that. If you try to do it from the satellite, you basically have to penetrate ceilings, like multiple ceilings. I mean, that's a lot. Given the distances also from the satellite to Earth, the satellite may be able to project the power, but the handset is kind of like small and it has limitations. And being able to penetrate back into the satellite, again, is another issue. What kind of spectrum do you use? Most of the carriers own the spectrum. When you start interfacing with people, the size of the battery, how long can it last? I mean, those are practical limitations. And then compile that or add to all of this the fact that people need more and more and more capacity by the day, especially as some of these apps like drones, driverless cars, kind of like start to proliferate. We're going to need more capacity rather than less capacity. I mean, these satellites will not be able to provide that capacity.
Hey, Sam,
there are great solutions, Tim, like offshore, rural, urban, mountains, provide some bridge, like in the Ukraine situation, for example, but they can't be a solution to the millions of people using their phone, for example, in a Manhattan or a Los Angeles or a London or a Lagos.
Right. It's just, apples and oranges. It certainly sounds like. Hey, Sam, I wanted to talk a little bit about the types of technology that these towers are providing. When you think about the different markets that you're in, are we talking 4G here? Are we talking 5G? I mean, what is the sort of standard in terms of the equipment that you provide or that the folks who lease and use your towers end up using?
Look, simply put, there is no difference in the aspirations of carriers and people in our markets to where the United States or Europe is. Everyone wants the fastest, cheapest pipe. Everyone wants 5G. Everyone wants fiber to the home. Now, having said that, we are definitely behind. Our markets are largely in the 4G cycle at the moment. Most of the 4G deployments have happened on our towers. They're selling it now to customers to upgrade from some markets 2G, 3G into 4G. Many of our markets like Nigeria, South Africa, Brazil have also seen 5G spectrum licensing recently. So we're beginning to see commercial trials or commercial pilots into 5G, but 5G is still not the standard. So it's largely 4G.
You guys offer 6 different solutions, including new sites, in-building solutions, fiber connectivity, small cell infrastructure in urban areas. Where are you most bullish for your company?
Look, for us, we think about it from a deployment point of view. What does the wireless network that carries a 4G or a 5G or eventually a 6G, what does it require? Initially, it used to require these macro towers, the big towers, and that's what most of us and some of our peers, American Tower, Crown, SBA, focused on. But as rollout starts to change, especially with 5G, more small cells will be needed. The DAS becomes very important. Fiber is critical as small cells start to get closer to each other. So the fiber connection to those locations become important. Also, we're seeing now compute and cache becoming very important. At the end of the day, those towers are the closest real estate possible to the eyeballs using a cell phone. So an element of computing could happen, potentially some data center or edge data center on these locations. What I'm trying to tell you here, there is no one size fit all kind of like solution. You have to be ahead. You have to look at the technology of the time in that country and what kind of rollout does it require. It always will require macro towers in our view, because that's kind of like the basic the umbrella kind of coverage. But all these other types, like small cells, like the in-building, like the fiber, will be required in different types and different instances.
Well, Sam, I could talk about this stuff all afternoon. I used to cover telecom, so I just love talking about connectivity and how people are getting connected around the world. Really appreciate you taking the time and joining us on Bloomberg Business Week this afternoon. Sam Darwish, co-founder, chairman, and CEO of IHS Towers, joining us on Zoom this afternoon. This is Bloomberg Business Week.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Nikola founder Trevor Milton has been ordered to spend 4 years behind bars for lying to shareholders about the electric truck maker's progress. He was sentenced today in Manhattan more than a year after a jury convicted him of securities fraud and wire fraud for misrepresenting key details about the development of Nikola's products and technology. Nikola shares today down 9.6%. Sun power plunged the most in 15 years after the rooftop solar installer said it has breached a credit agreement, and there is substantial doubt about its ability to keep operating. Shares today down 31%. Adobe has walked away from its $20 billion acquisition of startup Figma after clashing with regulators in Europe and the UK. With more on the story, here's Erica Herskowitz.
Charlie, Adobe will pay Figma a $1 billion termination fee. The companies say they saw no clear path to getting regulatory approvals from the European Commission Commission and the UK's Competition and Markets Authority. Regulators had been reviewing Adobe's proposed purchase for more than a year, demanding multiple rounds of documents and other information from the companies. Adobe said that the CMA's proposed remedies to allow the deal to go forward were disproportionate, and the company refused to offer fixes. The acquisition would have been one of the largest takeovers ever of a private software maker and was a massive bet that more creative work will be done by small businesses and everyday users on the web, a market that Figma has rapidly seized. Charlie?
Erica Herskowitz reporting, and those are some of our top company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovec here this afternoon. Carol Masser is out this afternoon. But you know who is in is Scott Carr. He's going to give us a check on latest world and national news, and he's in the Bloomberg 991 newsroom in Washington, D.C. Hey, Scott.
Good afternoon, Tim. The U.S. will join with a group of other nations now in creating a new force with the sole purpose of protecting ships trying to make it across parts of the Red Sea, many of which have come under attack by drones and missiles coming from Houthi-controlled areas of Yemen. Defense Secretary Lloyd Austin making that announcement today in Bahrain. Southwest Airlines is agreeing to a record-setting civil penalty over the holiday travel nightmare that it caused last year for millions of passengers. The Department of Transportation says the airlines agreed to pay a fine of $140 million. That's 30 times more than any other such previous fine. Secretary Pete Buttigieg says the outsized penalty is mostly about sending a message to the whole industry.
This is not just about holding Southwest accountable for the holidays and plans that were destroyed a year ago, but also about setting a new precedent.
Southwest is also ordered to create a fund that'll be used to provide travel vouchers to passengers whose flights may be delayed or canceled due to things beyond the airline's control. Amazon's sports streaming ambitions could soon expand. It's in talks now to invest in bankrupt Diamond Sports Group, which carries local games for roughly half the teams in Major League Baseball and the NBA and a third of the NHL. No word on exact terms or the price tag, but sources tell Bloomberg Amazon wants multi-year streaming rights to add to its Thursday Night Football and its stake in the Yankees and Brooklyn's Yes Network. President Biden's approval rating is falling to a new low. A new Monmouth University poll released today shows just 34% of Americans approve of Biden's performance compared to 61% who disapprove. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Scott Carr. Back to you.
Thank you so much for that update, Scott. Really do appreciate it. Tim Stenovec, live in the Bloomberg Interactive Brokers studio, joined by Charlie Pellet here. Hey, Charlie, are you a big food delivery
Absolutely
guy?
not.
No.
Absolutely not. And I'll tell you why.
Tell me why.
If you can't be bothered to go out yourself to pick up your bag of fast food, you're that lazy, you got to have it delivered, we're not going to be friends.
All right, but here's the... Okay, I used to share that sentiment, but then I had kids, okay? And then now I spend all my time chasing around these two little kids. And I'm telling you, delivery has changed everything for us. But I used to go out and pick up our food all the time. But you can't just do that when you're, doing bath time and stuff.
You know what? I use it to combine a walk for the dog, but I like going out to the local Chinese place, the Japanese place, the bagel place. I like seeing people behind the counter. They take good care of me. I go in and enjoy the human interaction. And no matter how bad the weather is, I'm going out to pick it up myself. You know why? The order doesn't get messed up when I pick it up in person. It's there quicker than I got to wait for a delivery guy, and it doesn't get cold. And on top of that, too, I'm not saying, listen, my wife does it all the time. We tip well when they deliver, but also it winds up being about 20% cheaper when I go to the store and pick it up myself because I'm not including a tip.
Well, okay, so that's exactly why we're talking about this, because it's actually even about to get a little more expensive than it's been. New York delivery drivers are seeing their first paychecks under a new hard-won minimum wage mandate. They're not ready to celebrate just yet, though. So get this, Charlie, the obligatory base rate for delivery workers is at least $17.96 an hour. That went into effect December 4th. It's resulted in higher overall earnings in the first week. Okay, that's probably not surprising. That's according to receipts seen by drivers sent to Bloomberg and posted on social media sites. But to compensate for the added costs, Uber, DoorDash, and Grubhub, which is owned by Just Eat Takeaway, have made changes to their apps that workers say will reduce their hours and could limit earning potential in the long run. One of the most controversial changes, Charlie, has to do with tipping, and they're going to pass, these companies are passing increased costs on to consumers in the form of added fees.
I just hope it all goes to the drivers. Those people, they work very hard for what they do, and just hope the people take care of them.
That's why I always tip cash when they arrive.
Not a question. You know exactly who it's going to.
Exactly. Hey, check out this story and more on the Bloomberg Terminal and at Bloomberg.com. Big thank you to Charlie Pellet. I'm Tim Stenevec. This is Bloomberg.